Alrighty, folks, we had Fed Day, and we are 24 hours after that. We have to pick up the pieces. My net summary of the Fed discussion was Jerome Powell got in front of the microphone, stuck out his right hand, probably his left hand, and flipped the bird to President Trump. Not only was there no rate cut in July, he also took the chance to kick the nuts of the chances for September. Going into the meeting, it was high as 66. It's now under a coin flip. In fact, Powell said this: we are looking through inflation by not hiking rates. Yes, not only were there no cuts, but Jerome Powell basically said, "You're lucky we're not raising rates," and that I'm sure has angered the big guy. Lots of other stuff to talk about, lots of Powell quotes, but let's bring Jonathan Twomley into this equation. And Jonathan, what did you think now, 24 hours after Fed Day?
So I'm not surprised that they didn't cut, because I really haven't thought they were going to cut. And so that, was not a surprise to me. What I did note was that there were two dissents about cutting, and they just happened to be from the two guys who were gunning for Fed chair and are trying to butter up Trump, right, by towing his line, because, they're so ambitious that they don't really care about the independence of the Fed. They just want the job, right? So that was to me like the highlight, I guess, a highlight or low light of what happened with the Fed.
Well, let's talk about that a little bit, because what people may not realize is we have had plenty of one-person dissents in the last 30 years. However, you have to go back to 1993, according to the Wall Street Journal, to have two dissents. And just so we know who they are, it was Michelle Bowman and Christopher Waller. So people don't realize that two dissents in a single Fed meeting, because there's only 12 voting members, right? There's 18 people plus Powell, but only 12 people vote in any one time. And to have two voting cut, that says something. To your point, perhaps it's 100% political.
Yeah, and not only that, I mean, a lot of the dissents in the past were also against cutting rates, right? That they thought that the Fed was cutting too aggressively. They thought it was going to wind up with exactly the problems that we had eventually, right? So it's just interesting to see. Really, I frankly don't see any case for cutting, and these guys want to cut, but we kind of know why they say they want to cut, because they want the job. So,
Yeah, it's really interesting, because again, if you just try to step back and let's pretend for a moment that Biden is president, or Kamala, or Bush, or Clinton, or something. Just take Trump out of the equation, because anytime you throw Trump in the equation, the whole conversation goes right and left, and it's not productive. So take any other human being on the planet, make them president for this conversation, and then step back and look at the economic data. Okay, unemployment rate last reported 4.1. It's expected to go up to 4.2. When I was in school, 6% was full employment. It's since been lowered to 5%. So if you don't know already, folks, 4.2 is a lot lower than 5. So full employment, check. And oh, by the way, we just got our third of 3 inflation prints, PCE, this morning, and it's up and up more than expected. In fact, the low was put in May at 2.5. It's now at 2.8. And again, I've been telling my audience, be wary. Next month, it's going higher again. We could be at 3% next month. So let me see. Stable prices going, no, not so much. So, and then, oh, by the way, you step back and look at all these freaking meme stocks, and crypto at record highs, and the stock market at record highs, and GDP at 3%. I'm like, who in their right mind would cut in this environment? And I'm a real estate guy. I'm like, what really? Remove Trump from the equation, and like, who's really thinking about a cut in this environment?
Yeah. And actually, let's kind of even broaden this discussion, because I listened to a lot of like international podcasts, right? So business podcasts from the UK and Ireland and places like that. And I was listening to a very interesting business podcast yesterday from the Irish Times, which is kind of, in Ireland, it's like the kind of like big conservative paper, in the Irish context, right? So it kind of makes it pretty like middle of the road for the US. And their business correspondent was talking about the big mistake that Ireland made 20 years ago to pour fuel on the fire before the great financial crisis by cutting rates, right? So and how that led to like a banking crisis in Ireland, led to all kinds of trouble that, that they're still dealing with the effects of today, even though the economy is very strong. Like housing crisis, because there was a massive housing boom and then bust, and so construction just dried up and it hasn't ever really picked up again since then, right? Because of that. So when you even take it out of that context and you say, well, why on earth would you want to lower rates when the economy is doing fine? You're just asking for trouble, right? So I think so then returning to what you posed the question, I don't even think we would be having this conversation at all were Trump not forcing the conversation.
Yeah.
Right. So
the one argument I hear from Trump and all, again, it's really funny when I go into Twitter or X after the rate decision, everybody was angry. And they were basically saying they were parroting Trump's words about costing us $1 trillion or $1 billion or whatever it was in interest. And I'm like, guys, we don't buy in the overnight market, right? If you cut in this environment, who says that rates don't go up like last time?
Yeah, exactly.
Right. And again, the last time I checked, the Fed's job is not to bail out Congress. The Fed was not put in place to bail out Congress. Congress has a spending fucking problem, and they should fix that. It's not the Fed's job to fix dumb things that the Congress is doing.
Well, not only that, but I mean, I've said this before. I mean, I've said that it's not the Fed's job to bail out Congress, but also I think the Fed bears a lot of responsibility for the budget deficit, in the sense that because they kept interest rates too low for too long, Congress was like, hey, we can borrow forever because look how low interest rates are, right? It's sort of like, just like the family saying, look how low interest rates are. I'm going to overpay for this house, right? Because my payment is low.
Yeah, and the Fed broke a lot of stuff by keeping rates low. And I've said for 3 years now, the Fed broke the housing market, and people don't want to hear it because they all feel the pain, affordability and all of that. I'm like, guys, we've got 5 to 8 years to get to the other side of this broken housing market. It's not going to be fixed overnight.
That's exactly the problems they had in Ireland, right?
Yeah, of course.
The rates were too low. It led to a housing boom. All the developers then went bust during the financial crisis, and they have not been able to build enough since then. They have a growing population in Ireland, right? Booming economy, and they cannot build any housing. And a big part of it is because the banks won't lend, right? Because the developers all went bust, and the banks are like, well, the hell with that. We're not lending to those guys again. Right? Is that what we want here in the U.S. And just going back, like if you look at this with a really long view, I would say not only did the Fed, break the housing market in the last couple of years with artificially low rates, they are directly responsible for the state of the housing market today, where everything is overpriced because 20 years of low rates.
I agree.
Has inflated the housing market, not just the housing market. I mean, look at this for everything. I look at a lot of, like, say, businesses for sale, not because I'm really actively looking at a business. I'm just curious. And every time I look at a business for sale, I'm like, how on earth is a mom and pop, people who used to buy these businesses, right? How on earth are they supposed to buy these businesses when they've got to come up with $500,000 or $1 million of a down payment on a business that used to, like, we're talking about like plumbing contractors, electrical contractors, like stuff like that, right? It's all because the Fed blew a bubble in everything, and everything went out of control. The price of everything went out of. So what do we want to do that again? Like,
do you want to because this is what again, right? We're mainly a real estate channel, and every real estate investor I know, big or small, they want lower rates. They think that's, and it's really funny because if you peel back the onion, some folks are still stuck in la la land that they think, and this is mainly the syndicators who did stupid deals, but they're basically angry because the Fed's not cutting because they think they can get a reprieve or buy some time to survive. You're not surviving. Did you hear about this $1 billion portfolio that just went bust in Houston? Eight apartment buildings, roughly one time valued at $1 billion, going to auction the second week of August. And there's just so much pain coming.
Yeah, and listen, I mean, there's a lot. We have a few more minutes left, so we can kind of rant a bit. But like, so I can't remember if I told you this last week because we were having all those problems with the Wi-Fi. But so I went and I've always suspected that you make more money at high interest rates and high cap rates than you do at low interest rates and low cap rates. And people don't understand this, right? They think very simplistically, low interest rates means you can buy more, and cap rates are going to be low, blah, 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 blah. So I went and did the analysis, right? Buying a property at a 4 cap with a 2.75 interest rate will make you less money and have a lower IRR than buying a 10 cap at an 8% interest rate, right? And even though, the spread is even a smaller percentage of your of your capital between 8 and 10 as it is from 2.75 to 4, right? Even though that relative spread is lower, right? You make more money and your IRRs are better. And why? Because you get more cash flow up front, right?
Exactly.
And people, and I always sort of intuited this, but I never ran the numbers. And then so I went and ran the numbers, and my intuition was correct. So everybody out there who's saying, "Oh, you can't make money in real estate because interest rates are too high," is only reacting to one thing, and that is that until prices reset, there's a mismatch between prices and interest rates.
Yep.
Right? That's the only thing. And because they're looking at it at a snapshot, and because a lot of these people who are whining are young and they don't really understand how the markets work, right? They came into the business in 2019 at the top of the market, and now they're whining about the market. It's because they don't understand how real estate works. They don't understand math. They don't understand interest rate. They don't understand any of this stuff, right?
Yeah.
They've never been through a full cycle, and they're just complaining because it was super easy to buy deals in 2019 when they started, when everybody was throwing money at everything. And now it's hard because the market is not corrected yet. And the market will correct.
Oh, it's in process. Yes.
It's in process. It's a slow motion correction, which is the other thing people don't understand. They're like, oh, well, it hasn't corrected yet, so therefore it's not going to correct. It's just like at the top when they're like, oh, the market hasn't corrected yet, so it never will. Now it's like, oh, the bottom's in because well, it hasn't fallen out yet. It's like, no, it will fall out. This is exactly like it was in 2011 when I started in this business. I know it's coming, right? And everybody should be happy about it.
Yeah, exactly.
Who bought at the top, who are complaining, and they're the loudest whiners out there, right? So,
yeah,
man, this gets
it's really funny because again, I go back to that one video. I think it's the best video on my channel. We did a video, God, it might have been 3 years ago, where we turned a $100 million building into 48 million. And people don't realize we were very conservative. We could have trashed that building to 28 million, right? If we would have moved the cap rate even more. And that's just pain that's coming. People are acting irrational, begging for lower rates and all of that. The commercial pain the momentum is building.
I mean, I almost want to see lower rates happen just so that all those people will be proved wrong, right? Because then rates will get lower, and then nothing will change. All their deals that are in foreclosure will continue to be foreclosed on. The mortgage rate.
I got to tell you, I don't want to see that because again, commercial market, you're absolutely right. You take rates down 0.5%, 0.75%, a full percent. It's not going to save any of these deals. They're still going to go bust, but it'll screw up the residential market. We have evidence the last 2 years of rates go to 5.99, so sub 6, people fly off the sidelines. I don't want to see that. We need more time to kind of get to the other side of this, and it's close. I think we're going to start putting in a bottom. I think August is going to be the last horrible month, and then September will be a little bit better, and then October will be a little bit better. Right? Nothing crazy, but the bottom is almost here.
What do you see though? I mean, I'm wondering about that myself because I've just been following, say, like Resi Club, right?
Sure.
And the news has gotten slowly worse if you follow Resi Club, right? Where for a while, a lot of markets were continuing to have price increases.
Yep.
But now you see the majority of markets are having decreases.
Well, it's not the majority. So again, I talk to Lance every Thursday. Resi Club's amazing. If you don't go to Resi Club Analytics. So where it started, I think these were kind of close to the numbers. Like I think 5 months ago, only 8 markets were negative, and then it went to 20, and these are all of the top 300. So I think the last report I saw was 120 markets or 123 markets of 300.
Okay, the point is the trend, though, right? So
no, it is bad. Yes.
yeah. So don't you think the trend is going to continue, though? I mean, I'm not sure that the bottom. Why? I'm curious. I mean,
So
just
we have to
wondering
be very careful because everybody wants to talk price, and I don't talk price. I'm talking transactions because price is very local.
Yeah.
Right. But and the reason I talk about transactions and nobody else does is because I'm an economist. Right. People don't realize this. The real estate market, when it's healthy, makes up 12 to 16% of the economy. We're in a fucking depression. So a lot of the slowness in the US is because of housing, right? Existing home sales, 3.93, down 40% from the peak. New home sales down, pending home sales down, cancellations up, delistings up. So we have a significant part of our economy that is not operating well. So what I see going on right now is we are finally cleaning up the MLS. What do I mean by that? We had a lot of people list, and we have growing inventory. Some would say it's up 40% year on year across the nation. My market of Vegas is up 77%. It's the top of the country. But what's happening is we got a lot of dirty listings. A lot of them have what I call wish pricing. And that stuff is starting to be removed as we get out of the summer months. Delistings were up 47% month on month. So what's happening is we are finally, Jonathan, getting to a point where we know who the motivated sellers are, who needs to sell versus who wants to sell. Mm-hmm. And that is the mark of a bottom in transactions. Because once you just have motivated sellers, you're going to have price discovery, and then we're going to see where we go from there.
I see.
Plus, in the future, I see rates going down. Now, not in 25, but sometime in 26. So once we go sub 6, people are going to fly off the sidelines, I think.
So you think that the price declines are going to be relatively limited because once you see interest rates go down, then it'll sort of put the bottom in.
Yeah, absolutely. Yeah, and the problem with interest rates is people always ask me. Actually, I got this question this morning, and I posed it years ago. If you want to see a pricing crash, like you want to see prices fall, you have to unlock the first-time home buyer. What do I mean by that? We have a broken housing market. One of the reasons and probably the only reason the median price is going up, again, existing home sales down 3.93. However, prices up 2% year on year. That's like, that blows people's mind. It shouldn't. It's math.
Yeah.
If you take a series of homes from cheapest to most expensive, and then you pick the one in the middle, that's median. However, because of the Fed, back to the earlier conversations, they broke the housing market. We have removed 30% of entry-level homes because they can't move up. They fundamentally can't get approved for that next house. So they're stuck. That inventory never comes. And then you take what's left, and of course the median price goes up. It's freaking math. So if you want to unlock, you got to take mortgages sub 4%. I am willing to say right now that the median home price would fall if mortgage rates were 3.99, because we would take 4 years of a low end, and that stuff would be listed because, hey, I want a newer home, or I need an extra bedroom, or I got to move, or whatever. And again, if you flood the market with the low end and the high end doesn't change, median price falls.
Well, that's interesting though. But then the competition for the high end is going to intensify with all those people trying to move up, right? I mean,
it would, but it would be such a distortion, at least in the short term, being 6 months. It's kind of like this proposal in Congress about no tax on capital gains if you sell your primary home.
Yeah.
Right. Because if you think about it, today we already have 250K single, 500K married. So if suddenly that goes away and now it's unlimited, you know what happens? There's a few very expensive markets like the Silicon Valley where you would likely get a rush of inventory and prices would fall, at least in the short term. Right? Because you got all these ex-teachers and ex-policemen who bought in the 60s who are staying there because they can't afford to move. They would suddenly move.
Yeah.
It'd be wild. So yeah, if you want to break the house, if you want to have lower prices, you have to unlock the low end. And I don't see us going sub 4, and thus we have at least 4 or 5 more years of subdued transactions.
Yeah, that's interesting. And I think that mirrors the commercial market as well. Because I think that transactions are down. They're way down off the peak. And I think they're going to continue to stay down because until we have price discovery. And this is
price discovery, yes.
This is just exactly where we were when I entered this market in 2011, where there was just not a lot happening. And the stuff that was on the market was just overpriced. And it took really until 2013, 2014 So we're talking 5 years after the peak, for the market really to start to get liquid again, where you started seeing deals come on the market that made sense in that interest rate environment, given the rents that were possible to achieve on those apartments. And then the market really, was able to get liquid again. But we're not there yet with the commercial market, because it's the same situation. Everybody is stuck. They can't sell because the properties are not worth what they were when they bought. They're underwater with the debt, and they basically are going to have to be forced to sell, because who's going to sell under those circumstances? So there are a lot of people who are holding out. Again, coming back to interest rates, they're hoping that interest rates are going to save them, even though they won't. But that's the thing they're clinging to. Mm-hmm. And we have to wait for this shadow inventory of basically underwater properties to hit the market in order for us to start seeing more liquidity. Yeah.
It's funny, Grant Cardone, I got to find this article, so I only read the first couple of paragraphs, but he's actually talking about the commercial market pain exceeding the great financial crisis. Because again, it's not going to be in residential, it's going to be in the GFC, and I believe that.
Yeah, no, I mean, I've been saying this for a long time, and I know I've said it on this show many times. The commercial market is going to be a harder crash than the great financial crisis, because the size of the bubble was bigger, right? There was, apartments, for example, went from being kind of like an obscure asset class that even a lot of institutions wouldn't touch, being the flavor of the month, right? And especially in particular markets where you had, places like Dallas, where there was always a risk premium for Dallas, right? For Atlanta. And the reason was because those markets are very easy to build in.
Yeah.
And there was always a risk premium in those markets. Well, that risk premium went away. And in fact, it was more expensive to buy apartments in Dallas and Atlanta than it was in New York or San Francisco or Los Angeles, where you have serious supply constraints, and the prices never fall as much because it's so hard to build, right?
Yeah,
so those places then got overbuilt, right? As they always do, but they got overbuilt even more than they did in the past.
Yeah, and there's even more inventory still coming, and you're seeing rent declines, and NOI's got to be getting hit, and insurance is up, and taxes is up. It's like the perfect storm for losses, and that's the pain we have to clear.
And everybody is talking about how, okay, well, the construction pipeline has dried up, and I mean, that happens in every real estate cycle. This is basically the real estate cycle, that construction they overbuild. Then nobody will lend because it's overbuilt. Then the pipeline eventually plays out, and then you get absorption, and then you get new building again. But it takes just because new starts have stopped and new permits have dried up doesn't mean that there's not an existing
more inventory coming.
It's going to take a while for all of that to be built, right?
Correct.
And it's going to come online, and then that stuff has to be absorbed. And then the other thing people are not really talking about much, I know you've talked about it, but I mean, folks, our population is not growing as fast as it was, right? And all those population estimates didn't take into account this massive immigration crackdown, right? Which is the main source of population growth in this country. With that crackdown, I mean, that's going to hit the demand side for all the apartments, right? And so I think there's a lot of pain still to come in the commercial space, and it's going to, like you said, be worse than the GFC.
Yeah. At the end of the day, folks, when you hear pain, if you're on this channel, you should be thinking opportunity. One of the things you could do is you could participate in some of these bigger deals. I suggest following Jonathan Twomley. He's done it before. He got out. He didn't do anything stupid during this crazy run-up. That means he's a conservative investor. Jonathan, where can people follow you?
Yeah, so please follow me on LinkedIn, or if you would like to join my investor list, just Google Two Bridges Asset Management LLC, and you can fill out the form there.
Very cool. Thank you so much.